Back to the channel. I'm Osborne Foreman, and in today's video I'm going to be talking about the new rule that I have made that helps me identify and buy better quality stocks. I feel that this certain rule prevents me from getting caught onto a lot of the risks or mistakes that new investors make, such as over-investing. I don't mean over-investing in terms of a capital mindset, I mean it in terms of actually the psychology behind investing, because in my opinion, the number one thing to master when investing in the stock market is your psychology. Because at the end of the day, you could know or you could identify some high quality stocks. You could see perhaps they are earning a lot of money. They might even be significantly undervalued. However, if you do not have the stomach to handle the volatility, you're likely going to sell out, or you're going to look to take profits when your investment's up 5%, when 10 years down the line, this stock could be up a multi-bagger. This could be up more than 1,000%, for instance. And if you like today's video, I'd like you to drop one of these to help beat that YouTube algorithm. And for the new microphone setup, hopefully the audio quality is much better. Lately, I've been reading a book, and this is called Richer, Wiser, Happier. This is written by William Green. I will leave a link in the description down below. I'm only currently on chapter 3, about a third of the way through the book, but it's about how the world's greatest investors win in the markets and life. In particular, in chapter 1, there is a gentleman called Pabrai. You may or may not know of this person. Myself being a UK exclusive investor, I actually hadn't heard of him. However, you would likely know of the person that he intends to replicate or clone, and has had a lot of great success through cloning this gentleman. Pabrai actively clones Warren Buffett. I don't mean cloning as if he just copies all of his stock buys and all of that. I mean he copies down his mindset. He's learned so much about Warren Buffett that he's effectively able to use Warren Buffett's knowledge and strategy and adapt that for himself. And I think this is a very important thing to do. And it got me very interested. Warren Buffett in particular is a gentleman that has been known to sit in an office and read a lot of the day. And I felt, well, reading is a very good investment in yourself, but how does one go the next step, and how does that help you select better stocks in the stock market? And I found something that I've really underused, and when I say underused, I meant I hadn't actually really done it. I'd skipped and scanned in the past and looked for specific things that I was looking to reference, but I'd never really just sat down and done it all. This, by what I'm talking about, is actually reading annual reports. I've heard accounts of many successful investors, I believe the likes of Howard Marks, Warren Buffett, and amongst many others. They will just sit in the office, they will restrict communication with many other people, and they will take more or less a hands-off approach. Obviously, I know Warren Buffett is obviously in charge of Berkshire Hathaway, and so he does have some leadership roles, obviously, but the fact that they just sit away and they read the annual reports. And it's very interesting in particular how they use this information to their advantage. They're not looking for all the positive qualities in a stock. They're not going, okay, yeah, this has got great earnings. Yeah, the price-to-earning ratios are good, but good earnings and an okay balance sheet. They're going, okay, this has good earnings, check. But the valuation's high. No, I will leave that for later. Or if I'm interested in it, I will read the annual report. And this is something that I've really wanted to adapt and develop in my own mindset. I'm having a lot of enjoyment out of reading books. I've been reading the likes of The Art of Execution, The Intelligent Investor, which is on the messy dresser behind me, and also Richer, Wiser, Happier. In particular, I found that reading is such a great way to increase your knowledge, and the annual reports really give out a lot more information than one would expect. I think in the markets such as the UK, this is very much an under-researched market, as in a majority of people in the UK don't really know what's going on inside the markets and are likely invested in funds, or there is little to no activity with analysts or researchers that are really looking into these markets, and so you can get some fantastic bargains in my opinion. And so I plan to use this to my advantage by acquiring more knowledge in specific companies than the likes of perhaps the majority of people, institutions, or retail investors. Not insiders, I was about to say, or even insiders, but that's just wrong. Then hopefully that would allow me to make a more educated choice based on how the investment story is and my understanding of it, of what I believe may happen in the longer term future. But then I'm always certain of the idea that the longer term future is going to be unpredictable and it's likely not going to be what we expect. For instance, in 2020, who could have seen the Black Swan pandemic event happening? Certainly not myself. Obviously, we had the likes of Bill Gates making a very a notable video in the past talking about how a pandemic could really set us up for failure, and well, he was right. But then I suppose a broken clock is always right twice a day. Whilst yes, Bill Gates was certainly innovative and thinking much ahead of the curve, I don't know if he would have perhaps predicted it. But I sort of derail here. The annual report, I think, is very valuable in a very good way. And it's when you know what information to look for and harness. I personally am going to use annual reports as the number one basis before buying an investment. This is because all the information I need, such as perhaps the executives on the board and senior management, or even the total workforce broken down by gender, I can see that on the annual report. Yes, you've got these apps like Simply Wall Street, which I've got here. Yes, it tells me that Games Workshop, for instance, is designing and manufacturing miniature figures and games. That, I think, is almost too simple. I look for very simple businesses. I've effectively cloned that from the likes of Warren Buffett and Benjamin Graham in terms of if I can understand it very easily, then I think it could be potentially a good investment, but there is obviously other criteria. However, getting a very, very brief overview like this can trick you into thinking that you understand the business. Don't get me wrong, Games Workshop really, I don't believe, is a complicated business, but there's certainly a lot more going on behind the scenes than what this would indicate. For instance, it says Games Workshop Group designs and manufactures miniature figures and games. It doesn't mention anywhere, unless maybe if I click about the company, about their black library. It might barely mention it, but it also says, look, short stories, audio dramas, full-length novels, and they are really creating a lot of content in this niche. In fact, I've recently read that in the Games Workshop annual report that they were actually, and this is their statement on diversity, and this is not something you would find out just from looking at the fundamentals of a share, that the company does not, however, consider that diversity can be best achieved by establishing specific quotas and targets. You may wonder, how is that relevant to your investment case? Because this is telling me about the quality of the management. This comment right here is suggesting to me that yes, whilst they're aware of perhaps the ongoing concerns or the changes in our society, that they are not going to establish quotas where they're going to go, we must have at least this many people of this type. Instead, they're going, look, we want to be balanced, we want to be fair, but at the same time, we're not going to sacrifice the quality of our management just for us like hitting certain quotas and targets to make us look better to society. And I think that's a really positive thing. And you can really gain a lot from reading the annual report. So my new rule is that I have to read the entire annual, the most recent entire annual report before buying any investments. I have obviously broken this rule because I've bought many stocks before this, and this is a new rule that I've acquired because I think it will help me make more informed decisions in the future. For instance, if it's a company that I perhaps am not too interested in, but I might have got caught into the hype. I might have seen on Twitter a stock like Tremor, and I might have gone, yes, actually, I'm very interested in this company. And if I quickly Google the ticker symbol, Simply Wall Street it, let's say Tremor International, right? This has had quite a pullback in the last 7 days of 14.7%. Obviously, in the last year, it's had a fantastic run-up. But it goes, provides end-to-end software platform that allows advertisers to reach relevant audiences and publishers. Okay, that sounds like marketing to me. That sounds pretty basic. I might quickly pop at the past performance and go, wow, okay, they've recovered very well. Look at the high profit margins. I'm interested. Or I might look at the financial health and go, wow, that's a fantastic balance sheet. With that much capital, that's a good thing to see. But then, what if I jumped into the annual report? And if I'm unable to read the entirety of the annual report, how would I know that I'm going to be able to then be able to hold through some of the tougher dips that this stock may encounter in the future? How would I be able to guarantee that? Because I need to have conviction. I think it's a very important thing that all of us should have. We should all have conviction in our investments. Not obviously a biased conviction where we're like, the stock's dropped, well, yeah, revenue's down by 20%, but the story hasn't changed, where perhaps you're turning each, perhaps, I'm going to call it opportunity bias, and it's something that I've certainly fallen victim before. Tremor International, for instance, they may have a profit warning, but you might go, actually, no, the story hasn't changed, this is a short-term impact. Although it may actually be a big concern, perhaps the management that have been elected are really trying to run the business to the ground, not directly, but aren't doing the same executive decisions. You're not going to really understand that. You're going to be wondering, why is my stock dropping? But if you read the annual report, you're going to understand, okay, what are the management trying to achieve? And you really get to understand some quality that isn't going to be tracked on these websites. They're not going to tell you really the quality of the management. For instance, they go, oh yeah, this is their average management tenure, but you don't really obtain that much knowledge about it. Yes, you get their compensation, how much they're earning. That is interesting. You can see how much they own of the company, but ultimately that's nothing, because the management themselves, unless they are high stake individual insiders, they are really the ones directing the future of the company. And so it needs to be in very good hands in order for future growth. And so obviously if you're reading the annual report and let's say you really struggle to get past the first 5 pages because the chairman's statement is boring you to death, then clearly you're not interested in the stock. You're not going to understand how it's got growth in the future or what value it has, so why bother buying? And I think this will eliminate a lot of things. I've mentioned in the past that one of my greatest mistakes, and I'll leave a card at the top right of the video, was buying my holding in Argo Blockchain. I'm not saying Argo Blockchain is a bad investment. No, that's not the case at all. But the mistake I made is falling for the fear of missing out, meaning that I was like, wow, this stock is dropping by an extreme amount. It's run up recently in the last year by a fantastic amount. I should be buying this dip. I need to get as much capital together as possible and buy. After all, buy when there's blood in the streets, right? Well, yeah, but I needed to be more patient. I needed to have some capital on the side and just slowly drip feed money into the investments. But how does this relate to the annual report? Well, if I'd have taken time to start reading the annual report to really understand what's going on in the business, I would then know, okay, is this a dip worth buying? Or can I see actually based on their book value that they're quite overvalued, and so this drop was perhaps from overexcitement and now panic, and that actually in reality I should be a bit more patient and hold off. Obviously, everything's very easy in hindsight. It's easy to win Sunday's lotto with Monday's newspaper. So in hindsight, I can easily go, well, yeah, the shares are going to drop because I've already seen the outcome of this. But I hope that it would future-proof my investing motion, because I found myself quickly drawn to attractive stocks. I have a watch list overall of about 30 plus stocks in the UK. And a lot of these companies I would love to buy. However, I think if I see a dip, and I look at the fundamentals only, yeah, it could be a good buy, but at the same time, you don't know the direction of the management. A good example could be perhaps Avon Protection. Avon Protection have had a significant drop in the last 30 odd days. In fact, they've dropped 40% in the last 7 days and 73.8% in the last year. You might go, never heard of them. You know what? They must be a low quality stock. Well, they were an absolute darling throughout 2020, and if you'd invested at the start at £20 per share, that had gone up to over £45 in just a year's time. So that would have been a fantastic run-up. After all, this was also a company that was actually increasing their dividend by 30% year on year. However, lately they've had a revenue concern of about 18%, and that caused shares to drop by over 40%, which is a bit baffling, although I believe it's due to an acquisition that they've recently made not doing too well. Well, I wouldn't know truly what's going on behind the scenes if I just saw, okay, yeah, the earnings aren't doing so well in the last year, but the revenue's growing. I might go, well, there's a lot of future potential. I might look at the financial health and go, actually, you know what, they've got a fantastic amount of cash. I should buy. And whilst this could work for a lot of people, you're not truly going to understand what's going on, because I'm not reading the annual report. I'm not seeing, oh, actually, the management made a big mistake. They didn't identify a risk in perhaps their ballistic helmet equipment that actually meant that they have to write off the majority of their inventory, or that if they don't sell their inventory soon enough, that the quality of the product diminishes and no longer has its effectiveness for safety purposes. Obviously, I've just completely made that up, and it's very unlikely that that would happen for safety equipment or gear or PPE, personal protective equipment, but the idea still remains, and it keeps you more in line with the direction. And I think it's a very, very important step that I think hopefully some of you watching this video would like to take into mind, because I know in the past I've been very prone to fear of missing out, buying a stock and then actually going a few months later, oh, well, I liked the stock at the time, but now that my knowledge has increased, I'm not actually that interested. For instance, a good example of this could be some of my previous holdings. I've held the likes of Royal Dutch Shell. I even held some BP. I made a video going, oh, actually, don't buy these stocks. They're not good. And in hindsight, after that video, I got a lot of hate, but that's not what made me realize it. What I realized is actually, no, I really lack understanding in these businesses. I thought it was a simple fractional distillation thing, but there's upstream and downstream, and I was starting to get confused very visibly by that. And so I realized, okay, maybe I shouldn't have made that video because I didn't know what I was talking about. But at the same time, like, If I didn't understand what's going on but believed I did, reading that annual report would have been a very quick double check. Either I would be interested in learning more, and if I am, that's a good sign. That gives me perhaps a competitive advantage or a unique selling point in that industry. Or I would have went, actually, 2 pages in, I don't like the direction of this company, I don't really understand it, I'm not going to buy it. And that would have saved me 6 months down the line, selling out, perhaps at a loss, maybe at a mine again, or if you're lucky, a very good gain, and going, well, I messed up, what can I do? Oh well. Instead of dismissing that mistake, I really feel that this would help benefit yourselves. Obviously, this has been a bit of an odd video. I don't know if you were expecting this. I don't even imagine this will get many views, but I do feel that this is likely my highest value video that I've made so far. Maybe it's the quality of the sound. No, I'm just winding you up. But I feel that through reading more, I'm learning more, and I hope that the same lesson can be learned to you. I do understand that a lot of you are much more experienced investors than myself, but then we don't want to fall victim to our own egos or arrogance, because after all, if there's a point where you think you're on top of the world, you're not going to be learning more. And at that point, you're going to be set up for a very hard fall if things go quite badly. If you'd like to know how many shares of a stock that you need to hold to get £1,000 a month in dividend income, then click the card at the top right of the video. Thank you for watching. I'm Foreman. Have a fantastic week.